In this session, we will discuss infrastructure investing and how institutional investors such as retirement funds can benefit from investing in this type of asset class. There are many definitions capturing the same meaning of the term infrastructure. For instance, the Oxford Dictionary defines infrastructure as basic physical and organizational structures and facilities needed for the operation of a society or an enterprise. Examples of infrastructure include buildings, roads, power supplies, information technology installations, and others. Investing in infrastructure has been shown to stimulate economic growth and have a positive impact on society. In a developing country such as South Africa, the effect on economic growth and impact on society can be expected to be even more beneficial. Providing appropriate infrastructure can lead to efficiencies in an economy. For example, having suitable road infrastructure is important for the movement of goods within an economy. The development, maintenance, and improvement of infrastructure require funding. Government funding is one of the main types of finance available for infrastructure projects. However, governments often only have limited resources available to prioritize funding across competing national initiatives in their budgeting decisions. In South Africa, the government has been borrowing money to fund consumption expenditure, and this has not resulted in economic growth over the last decade. The South African government now finds itself in a debt trap. Hence, the private sector may be looked upon to play a role in financing infrastructure. Given their large scale, infrastructure projects are often financed over very long periods. Retirement funds have significant pool of assets, and being long-term investors potentially makes them ideal investors in infrastructure. Members of retirement funds may benefit from getting access to potentially inflation-beating investment returns over the long term. One of the more prominent risks of investing in infrastructure is the illiquidity of the investment. This means infrastructure investors are often not able to exit their investment early, but only at the end of a contractual period. It is not uncommon to see contractual periods of 15 to 20 years for these types of investment. Retirement funds often need to realize their investment to pay out benefits to members. If the required benefit sums are very large, retirement funds are able to retain illiquid assets and realize those with sufficient levels of liquidity. Hence, retirement funds need to manage the exposure to illiquid assets such as infrastructure. In return for having their capital locked in over such a long period, investors expect to be compensated for this and earn what is referred to as an illiquidity premium. At a high level, the process required for infrastructure investing will involve identifying the opportunity and performing various types of due diligence, including investment, operational, and legal due diligences. The overwhelming majority of retirement funds simply do not have the time and expertise required to directly invest in infrastructure projects. Hence, retirement funds will typically consider an investment manager with expertise in infrastructure investing for assistance. Smaller retirement funds and those with low governance budgets will usually be invested in multi-asset mandates or balanced funds where investment managers are given discretion to allocate capital across asset classes and select stocks within the asset classes. Investment managers managing these types of investment portfolios have not been significant investors in infrastructure because they generally do not have the expertise to manage infrastructure investment, and they cite operational illiquidity and counterparty risks not being adequately compensated when looking at expected returns. Larger retirement funds or those with reasonably high governance budgets can access investment managers within the alternative space who who include infrastructure in their investment portfolios. A number of managers of infrastructure or infrastructure-heavy portfolios have established investment track records within the space. Energy has been a sector that is attracting a significant portion of infrastructure spending. This has resulted in investment portfolios with energy infrastructure themes being launched. To address sustainability, some investment managers have launched clean energy funds in response to the global decarbonization theme. Investing in these types of investment portfolios can be appealing to retirement funds because they can access the expertise required to identify and manage infrastructure investment opportunities. Another benefit is that portfolios offer diversified pools of infrastructure investments. However, retirement funds have been reluctant to invest in the infrastructure funds because of the reasons including the following. Infrastructure funds are looking for patient capital and will typically have a lock-in period. For example, an investor may not be able to realize their investment for the first 5 years. While infrastructure investments can offer above inflation returns on a sustainable basis over the long-term periods, South African retirement funds have experienced high investment returns within listed investment markets. So, when expected returns in these markets are high, infrastructure investments often have to compete for an allocation within retirement funds' investment portfolio. However, it's important to note that infrastructure can improve diversification within retirement funds' investment portfolios. To summarize, infrastructure investing has the potential to stimulate economic growth, make a positive impact, and deliver inflation-beating investment returns for investors. Retirement funds are able to access investment managers with established track records in managing infrastructure investments for the benefit of their members.